Hello, good afternoon. This is Adam Farkas speaking from AFME. You are attending the AFME members call on COVID-19, and we would like to welcome all attendees. We have got over 100 attendees registered. I can see the number of colleagues joining, reaching about 50 right now. So what we would like to do today is two things. The first one is to give you an overview of a report which AFME recently issued on the COVID-19 impact on capital markets. Julio, my colleague, who is the director and heading our research effort, is going to introduce the report and engage with you and discuss the findings of the report. And then that will hopefully take about 15 to 20 minutes. And then in the next section, I will give you an overview of AFME's COVID-19 related activities and developments. And that will also take about 15 to 20 minutes. And after these introductory sessions, we will have time to have a general Q&A session with all of you possibly participating. So on that note, let us start the first part of the discussion today. Let me pass the floor to Julio, who is going to introduce the report which we recently issued on the COVID-19 market impact. Julio, the floor is yours.
Thank you, Adam. Indeed, we recently published a report on the initial impact of COVID-19 on European capital markets. I'm Julio Suarez, I'm Research Director at AFME, and I produced this report with other colleagues at AFME. Today I want to present the main findings of this recent research publication. And of course, there's no doubt that, well, the COVID outbreak has had a significant impact on a wide range of areas, including, of course, on the functioning of capital markets. The purpose of this report is to provide an overview on the initial impact of COVID on the different capital market product lines. The report also provides a comprehensive analysis of the recent trends during the current abnormal market circumstances. The report also summarizes AFME's approach to COVID-19, which will be presented in more detail later on by Adam, and the areas where we have been focusing on to ensure that markets remain well-functioning and liquid in light of the impact of COVID-19. The main conclusion of the report is on the slide in your screens. Overall, while prices and spreads have shifted considerably, European capital markets have continued to operate well following the outbreak of COVID-19, with liquidity, of course, ranging from very good to mixed, depending on the sector. In fact, there have been record volumes of new issuance in certain sectors, as we will discuss in more detail in the next slides. The report was launched or was published just last week, Monday, with data as of mid-April, so it does not cover some of the most recent policy announcements and market events. So if we go to some of the details and the first slide, and by product lines, we can start with the corporate bond market. Issuance of investment-grade corporate bonds by non-financial corporates surpassed 50 billion euros in the first week of April. This was, of course, a record amount. This was the highest weekly amount ever issued in Europe, as shown in the bottom chart. French companies have been particularly active in this respect. And this is, of course, quite remarkable, given that many companies, if not most financial market participants are currently, working remotely. I'm sure also colleagues on the line are also currently working remotely. The rapid increase in investment-grade bond issuance, however, contrasts with the subdued performance of the high yield and leverage finance markets. It's not shown in the slide, but we address it in more detail in the report, where investors potentially, or most likely, are pricing in potential credit losses of low-rated corporate debt. In the report, we show how credit spreads have widened for high-yield debt and leverage finance products. In particular, for high-yield bonds, spreads widened from around 300 basis points in January to a maximum of around 866 basis points in March. And although most recently spreads for high-yield bonds have tightened to levels closer to 640 basis points. This, of course, has made it costly for low-rated corporates to issue debt in the high-yield market and in the leveraged loan market. And we show actually in the report how we have actually seen a reduction in bond issuance and in leveraged loan issuance over the last few weeks. If we move to the primary equity market, we also show in the report that, non-financial corporates have also rapidly increased their secondary equity offerings in an effort, to raise their cash buffers and withstand the business closure for several weeks. And indeed, we have a closer look, a close inspection of companies offering the documentation. It reveals that about more than half, around 2.5 billion of the 5.6 billion capital raised between March and April of this year was explicitly attributed to COVID-19 use or as use of proceeds. And what we note in the report that this might be highlighting some need to raise cash in the current market environment, either for debt repayment, for working capital, or to also explore potential opportunistic M&A transactions. We provide a breakdown of use of proceeds in the report. On the other hand, of course, markets are more volatile than a few months ago, which has made it costly for some companies to list through IPOs. European equity share prices, we are well aware that have abruptly declined between 20 and 26%, which, in addition to the rapid increase in equity market volatility, has resulted in an increase of around 300 basis points in the cost of equity. This based on third-party research providers. As a result, IPO issuance on European exchanges has declined around 83% year to date compared to the same period of a year ago. So comparing January and mid-April of this year compared to the same period of 2019. If we go to this slide, we provide a more detail in the report, and we provide a few charts as well, where we note that capital markets have been playing their role in providing liquidity, in facilitating price formation, and contributing to capital allocation, and of course helping investors manage their portfolios. We note in the report the significant increase in equity trading. Equity trading has surged around 94% year on year in March of this year. We also note in the report that corporate bond trading increased 31% year on year in the first quarter of this year. And we also note in the report that FX trading, FX spot trading, rose 61% year on year in March of this year. Now, we also cover in the report the government bond area, and we also note that government bond trading volumes in the first quarter of this year were up, increased about 26% compared to the last quarter of 2019. And compared to the same quarter of 2019, we observed an increase of roughly 4%. In Spain, particularly in Spain for the government bond area, the three largest average daily trading volumes in our records of Spanish government debt were observed in January, in February, and in March of this year. Now, the rapid increase across virtually all securities trading and post-trading activities has been carried out without any major disruption from a business continuity perspective. We note in the report that, for example, according to ECB's data, settled transactions at the ECB's T2S platform have increased to over 1 million on average per day since 24 of February. This is compared to around 600,000 daily on average in 2019. And we also highlight that in mid-March, actually, the average settled transactions, or the total settled transactions in mid-March, reached 1.2 million, again, compared to roughly an average of 600,000 on average in 2019. Now, the fail ratio has continued, as we show in the chart, has continued at around between 2 and 3%, meaning that, we of course saw an increase in the volume of fails, but they were roughly proportionate to the increase in trading volume. This is based on anecdotal evidence and also according to some interactions with some market participants. If we move, we provide a kind of a closer look to the securitization market in the report, as you can see in the slide on your screens. We note that, indeed, the issuance in the first quarter of the year of securitization product in Europe totaled roughly 29 billion, which was 6.6% lower than the issuance volumes observed in the same period in the first quarter of 2019, which indeed, even the first quarter of 2019 was in itself already a record low, already a record low volume due to the complications in the market faced during the first months of the new STA's regime, the significant, transparent, and standardized securitization regime. And we also note in the report, as you can see on your screens, that spreads have widened for European securitization products. And we know that while the ECB's announcement of the Pandemic Emergency Purchasing Program, the PEP, has already had a positive effect in government bonds and other fixed income sectors, this has not yet been necessarily observed in the securitization market to the same extent. And we indeed observe in the report that spreads have widened and pressure on liquidity in the securitization market has been relatively disproportionate compared with other fixed income sectors. And more broadly, and as we had interaction with some market participants and with some regulators and some people at the Commission, we see that there's a direct correlation between central bank support and improved liquidity conditions across the different asset classes. And in terms of securitization, we note also that while the 7th of April announcement on reduction by the ECB of haircuts across all sectors is helpful to some extent, we also note that, for example, there is no recognition of the STS label of the on the ECB's market operations, something that we note in the report and something that we have highlighted in other communications. Now, we finalize the report with some figures of the European banking system. We are aware that in Europe, the IMF estimates indicate a decline in GDP growth for 2020 of around 6.5% in Europe for the whole year. And particularly for the second quarter of this year, the IMF expects a decline of between 20 and 40% in GDP growth. So, well, of course, this is quite severe, but it's also, more severe than stress scenarios modeled by the EBA in 2016 or 2018. However, well, as seen as the report shows, well, banks interacting in the European market are well positioned from a solvency and liquidity perspective to support households and businesses during this period of abnormal economic stress. As shown in the screen and as shown in other AFME publications, we note that well, since December of 2013, the average endpoint CET1 ratio for Europe's largest banks, or EU G-SIBs, have accumulated an increase of 363 basis points from 10% of CET1 ratio in 2013 to 13.63 in December of 2019. Now, this ratio represented also the highest quarterly solvency ratio in AFME's database. Our database dates back from December of 2013. But also having a look at the most recent EBA's data dashboard, we also observed that according to their data, also European banks reported the highest CET1 ratio in recent history. We also note that, of course, the current crisis is testing the post-financial crisis and the whole post-financial crisis architecture and the response of the EU and national authorities. It is testing, of course, the coordination and the speed of response of member states, of the European Central Bank and other national central banks. Now, to conclude, worth to mention that also in the report we cover other sectors. We cover also mergers and acquisitions transactions. We also covered sovereign debt and also derivatives trading. I'll just give a quick overview on some of the recent figures on these markets. For example, in Europe, we note that there was a significant decline in announced mergers and acquisition transactions, the volume of announced M&A transactions. And indeed, the value of announced deals abruptly declined to below 2 billion per week in the most recent weeks of April, compared to weekly averages of roughly 15 to 20 billion in the first months of the year. So indeed, from 15 to 20 billion to roughly 2 billion in most recently per week. Now, going forward, however, there could be, of course, a prospect for opportunistic M&A transactions whereby, businesses that are vulnerable can be, of course, be subject to a takeover if that's the case. In the sovereign debt markets, we also provide a detailed analysis in the report. We note that indeed sovereign securities, the demand for sovereign securities remains robust, and indeed the average bid cover ratios by jurisdiction in the first quarter of the year stood within average levels observed in recent quarters. And most recently, we have read market news basically reporting an increase in bid cover ratios in some recent government bond auctions, which is, of course, quite encouraging. In terms of derivatives trading, in the report, we also mention an increase of roughly 43% in interest rate swap trading, also an increase in FX swaps of 4% year on year, and an increase in outright FX forwards of 11% year on year. The other sectors that are not covered in the report, but of course are quite relevant, relate to the pre-IPO SME finance market. We don't necessarily have enough data at this stage in the report. We do cover the IPO market, and we do cover the M&A and PE-backed M&A transactions, but we don't cover in detail, for example, venture capital, private equity, or private debt, more generally, private markets. We note, however, most recently, a significant decline in the amount of NPL sales or distressed debt sales or non-performing loan sales in the first quarter of this year, according to DebtWire. And of course, well, this is important. Of course, the liquidity of this market will be crucial to help banks free up capacity and continue to support the economy in the current circumstances and over the next few quarters. Now, AFME will continue to monitor, of course, the developments in the current atypical market environment. And just to also note, and as a form of advertisement, we produce every quarter 5 data reports across several asset classes. We cover the high yield market and leveraged finance market, the ABS securitization market, the government bond market, equity primary markets and trading market, and also the bank capital and the contingent convertible market. And these are quarterly reports that are distributed and are publicly available on our website. And in October, we will also launch the 3rd edition of our annual Capital Markets Union Key Performance Indicator Report with key data at the EU and member state level across several features of capital markets activity. That we will plan indeed to launch this report in October, and that will be, of course, a good opportunity to analyze, kind of more recent trends and how markets continue to evolve, also at a member state level. So with that, I thank members for joining this call, and I hand over to you, Adam, and of course, I'd be happy to take any questions in the Q&A section. So thank you very much.
At the end. What I will do now is try to explain to you what AFME has done so far for members, to represent members in the current situation, in the current COVID-19 environment, and how we structure this work, what we have done and what we have achieved for the benefit of members and for the general benefit of the economy. When the crisis intensified, we decided to create horizontal work streams within AFME, maintaining the policy committee structures and leaving the policy decisions and policy discussions with the existing structures, but we created an internal structure which is horizontally cutting across the organization, and we organized our efforts into different work streams, different projects, as if you want to call them. We identified 4 distinct projects, and we also produced a 5th report, which I will not talk about here today. The 4 work streams was the first one was dealing with compliance and supervision issues in the COVID-19 environment. The second one was dealing with regulatory implementation challenges that are implementation deadlines coinciding with the crisis. The third work stream was dealing with consultation delays and generally policy consultation papers that were outstanding and the deadlines were falling due in the near term, coinciding with the most immediate steps members had to take to respond to the crisis, and therefore we were seeking for various delays of these consultations with the respective authorities. And the fourth work stream is of course related to prudential regulation, where I personally didn't participate in AFME's work due to my own restrictions, but of course the team was very actively engaging with the prudential colleagues of members and the prudential authorities. So let's go one by one quickly to summarize what we have been doing and what we have achieved. In the compliance and supervision area, of course, the immediate priority for all members was to allow the operating model of member firms to change in the COVID environment in response to all the restrictions that have been introduced by governments and government agencies in various European countries. So the first challenge was to make sure that banks could move to their BCP sites, their recovery sites, and then shift to a partial and then nearly full work from home arrangement, while still maintaining full compliance with the rules and regulations, especially in the trading and sales functions of our members. So we have engaged with the conduct authorities, with the market supervisors across Europe, primarily across the markets that are the most material for European capital markets. And in response to these engagements, we are of course not alone. Firms have engaged bilaterally as well. Other trade bodies also engaged on the same matters. But finally, we got to a point where the authorities, the FCA, ESMA, and other European national authorities issued sufficient guidance and communication publicly, as well as in a bilateral framework, to guide firms as to what the supervisory expectations are in terms of the major compliance requirements. So what we can say today is that the industry and the markets have proven to be resilient, functioning well, and in this new normal, or this new operating model, the compliance issues do have clarity with respect to between the supervisors and the firms. We also, more specifically on some other issues we engaged was we tried to get some clarity on that was more UK focused on the expectations and implementation of the senior managers regime in the new environment. We engaged on the LIBOR transition issues, how this project is going to be influenced by the COVID-19 crisis. And here the outcome is that so far the final deadline is not moving, not yet moving, I would say. But some of the intermediate deadlines are moving. The reason why I'm saying not yet moving is because the corporate sector is becoming more and more vocal, both in the US as well as in Europe, arguing for some delays in the overall deadline of implementation, and that might trigger some discussions on this. But of course, this is not conclusive at this point. We have also engaged with some national supervisors on specific issues that concerned our members. We had long discussions with BaFin, the AMF, and the Danish authority on specific issues of concern. Also, we approached the Spanish authority on some specific questions. So whenever there was a need, we got in touch with the national authorities. One last point in this area I would mention is the short selling bans across some European countries, member states, EU member states. As we all know, some member states introduced these short selling bans on a wide range of issuers, and we played a role in clarifying these restrictions to allow a full implementation of the individual restrictions. On the overall issue of short selling, according to members' position, AFME has not been vocal or advocating for the expiration of these bans or for the stop, advocate for a stop of the short selling bans. But it's something which is continuously being discussed among the membership. The second major area of activity was implementation challenges. We have identified a number of in-flight regulatory implementation challenges that just simply coincided with the height of the COVID-19 crisis, and therefore we assessed and analyzed whether some delays of these implementations were warranted. And AFME got into immediate action with the respective authorities to ask for these delays. I would mention a few important ones here in this area. For example, we all remember that the new tick size regime was to be implemented in the last few weeks. we engaged with the authorities and achieved that there will be a delay, which is now publicly known, of the implementation deadline, simply because of the operational challenges of this implementation. We have also advocated for a delay of the SFT regulation implementation deadlines, which are related to reporting obligations under the SFT regulation, and this was also agreed by the authorities. We also engaged in the UK with the PEG, with the preemption group, to request a temporary relaxation of their guidelines relating to shareholder preemption in certain share issuances by listed companies, and we got that temporary relief. It was widely reported in the press. We have also engaged with different authorities on tax issues. So we requested delays on the reporting obligations on the DAX 6 tax, and also we have put in a request to address some of the challenges that are stemming from the way withholding tax procedures are designed and implemented, which in the current environment can lead to specific operational difficulties. We have also submitted jointly with 10 other associations to DG Just a request to delay some of the implementations of the Shareholders' Rights Directive. So this was a very busy period. It's not everything has been addressed by the authorities, but in a number of critical areas, these implementation challenges were taken up by the regulatory community, and banks got temporary relief from these obligations. The third large work stream, as I mentioned, has been consultations, CP responses. And these were, again, sort of coincidences of different deadlines that were put out by the public authorities, by the European authorities, both at the Commission level as well as the ESOS level, and in the UK, typically by the UK Prudential and Conduct Supervisors. And there was just simply not enough bandwidth within the technical experts of members and AFME technical experts to prepare the usual high quality evidence-based input to these consultations within the tight deadlines. Some of these consultations have been accelerated in terms of the response deadline, not knowing that COVID-19 was coming, and therefore they proved to be nearly impossible to observe, and that would have led to a sort of reduction of the quality of responses public authorities would have received. Therefore, we together with some other trade associations, sometimes on our own, we went out and engaged with the authorities, and we achieved significant delays of these deadlines. In the UK, there was a wide-ranging delay until October of practically all non-essential consultations. The EU was not as generous, and the EU authorities have not been that generous, but we typically managed to achieve at least 1 or in some cases 2 months of delay of the CP deadlines. I will not, in the interest of time, I will not go through each and every one of these, but there is a long list of consultations that were delayed. In the fourth area, in Prudential, again the plate was pretty significant, very much full. And AFME got mobilized very quickly by the Prudential teams, or the Prudential experts of members. The first wave of efforts were aimed at trying to assess what flexibility in the existing regulatory and supervisory framework there is to allow supervisors to provide regulatory relief in terms of the prudential requirements, and therefore allow banks to eat into these requirements, eat into these buffers, both on the liquidity as well as on the capital front, and maintain their ability to keep financing the economy. I think, in summary, what we can say is that the authorities responded very quickly and positively. And the third point I would mention is that there was a lot of coordination, not only between the EU authorities, i.e. the SSM, the EBA, and the national supervisors, and the PRA on the UK side, but also there was a global coordination with the Fed under the Basel Committee's umbrella. So authorities came back with a lot of relief measures. Counter-cyclical buffers were freed up, and authorities explicitly allowed the banks to eat into their capital stack and their liquidity buffers, which provided an immediate and temporary relief. Then, of course, in the next wave, other questions came up with the announcement of a number of government measures that provided different facilities guaranteed by the public sector for banks. A lot of interpretation issues came up as to how those claims and other financing facilities would be treated under the prudential regime, and so AFME and other trades accessed the authorities to get clarity on these. This was a next wave, and then in the third wave there are a number of areas where members are requesting temporary changes of the rule book itself, including level 1 changes in the prudential regulation in Europe, in line with the agreement and the communication of the Basel Committee, which is allowing some relief on the implementation of the Basel rule set. So currently, AFME is very strongly involved in this effort, and as you might well know, there is an expectation that on Tuesday, i.e. tomorrow, there is possibly a new legislative proposal will come out from the European Commission, allowing a fast-track legislative process to make some changes of the level 1 text of the CRR/CRD framework in Europe. I would be happy to talk about what the specific proposals are expected to be according to our best knowledge, but in the interest of time, I will stop here and allow potential questions from you to Julio or to myself along the lines of these presentations. So thank you. I will stop here, and I let the organizers to open the Q&A session.
I see that there are two questions in the Q&A bar. The first question, and of course, colleagues are more than welcome to submit their questions via the system. I see that the first question is, what are the areas of capital markets that have been hit worse by the crisis, and what can we do to help? I think, well, as shown in the report, and as we show also in the slides, we have seen a significant decrease in IPO issuance in Europe. Again, comparing the first 16 weeks of this year compared to the same 16 weeks of last year. We saw a decline of around 82%. I think it's what I mentioned in IPO issuance. So of course, well, this is perhaps one of the sector's hardest hit. Of course, it's as consequence of the market volatility and as consequence of repricing and a significant decline of valuations, and of course an increase in equity, in the cost of equity. Now, what can we do about that? Well, I think it's important to continue to maintain all the kind of the pre-IPO elements functioning. I'm aware that the European Commission is planning to issue a communication on Capital Markets Union. So it's important that that communication should indeed consider the pre-IPO and also the IPO elements of the market. I don't know, Adam, if you like to add anything on this question.
No,
the areas
not on
this hit.
I think generally one general comment is that what we have seen both in the US as well as in Europe is where, especially in the initial phase of the crisis, was that when and if central bank support was provided explicitly to a certain segment of the market in the form of sort of underpinning the market with central bank measures, provision of liquidity, direct purchases of securities, these segments of the market stabilized much faster, understandably. And in other segments of the market which were not immediately supported by direct central bank intervention, of course, volatility has proven to be much higher. Spreads widened much more and remained so, and the liquidity of the market was suffering. So there was some dislocations in these markets compared to those markets which were directly underpinned by central bank measures. Now, this is not a surprise in our view, but what is the major lesson from this is that the authorities will have to be extremely careful when they at some point will gradually withdraw these direct support, because of course it can create additional tensions and market volatility and problems with liquidity in the future when the measures are tapered or gradually withdrawn. It's not a question for today, but it will clearly come back.
That's a very good point, and well, effectively the ECB is purchasing around 750 billion euros of fixed income securities. There are market rumors that the ECB might even consider to purchase a high yield debt. So, of course, this is a market segment that will potentially respond to any future market interventions. I see that there are also other questions.
Yeah, there is a next question. By the way, I think we haven't said it, but if you would like to pose a question, there's an icon on somewhere in the middle of the screen on the right hand side, which is blue and says Q&A. You can click on it and then pose questions to any of us or both of us, and we will see these questions so we can answer them. The next question I'd like to respond to is a question asking, what are the major decisions from authorities we are waiting for? I think there are quite a few. In the prudential area, without trying to be comprehensive, the key question outstanding now is the exact content of the legislative proposal which is coming out of the commission now, with respect to what it is going to cover and what the time frame of the temporary measures will be, which we expect to be in line with the Basel announcements. In terms of the content, we of course do know what is being covered, but we don't know the final details of the upcoming proposals. Although there have been discussions, preliminary discussions with the Council and the Parliament on the upcoming proposals, so we have a pretty good knowledge of what is envisaged. In the consultation area, I would say that with these delays, we have sort of a settled status of the existing CPs. I think that the big question I would have is whether there is, and this is true for the UK as well as for the EU on the way forward, is how and when a comprehensive review of the MiFID framework is going to take place. I think that's a bit. It's more of a strategic question, not an immediate regulatory question. But I think as a response to this crisis, the key question will be the scope and the timing of a review of the markets framework, the MiFID/MiFIR in the MiFID/MiFIR context. That's a strategic issue we will have to deal with. In the implementation challenges, I think there are, as I mentioned, there are some letters which have not been addressed or we have not received responses in the shareholders' rights directive and in the tax area. So we are still expecting responses on this. Here, I would mention one other important area here is that we keep trying to reach out to the Commission as well as to the ECB with respect to helping the securitization market to take off, and we clearly see the need for further measures from the monetary authority as well as the Commission. And that is moving relatively slowly. So that's an area where we are expecting further action, not necessarily strictly and only in relation to COVID-19, but more generally. And of course in the compliance area, the big question will be the longer term fate of the short selling restrictions and the progress with the LIBOR transition. I hope this was a good summary of where we are still expecting decisions. There is one, let me check, there's one more question. So there's one question. A lot of advocacy has been firefighting. When can we expect priorities to shift back to what they were pre-pandemic? I think that it is coming back. It is coming back slowly. I think now the policy focus, especially in the financial services area, is gradually shifting towards focusing on the sort of the recovery phase of the crisis, assuming that the health pandemic is going to be controlled by the respective authorities, and there will be a slow return to some normality very soon. And of course, a key issue will be the economic recovery. And I think in that context, there is a lot of review, an ongoing review by the regulatory community as to what priorities would need to be changed in the post-COVID context. I can mention, for example, one debate which we are very actively engaged in is the sustainable finance agenda. How COVID-19 is going to influence the sustainability or more broadly the ESG agenda of the UK and the European Union. This we can expect that we will shift back to the original agenda, possibly with some modifications in response to COVID-19. But again, I also mentioned the MiFID review, which will clearly be under the radar. We are shifting back gradually to that. but some strategic issues will need to be decided as to the scope and timing. And we can then, the next one in the prudential area will of course be the full scale implementation of the final Basel package, and then we could go on and on. We are gradually shifting back to these, but every one of them will probably be assessed and reassessed as to what needs to be, if anything, needs to be changed in response to COVID-19. There's another one. Okay, CSDR. There is a question about AFME's view on the prospects of further delay to the CSDR. Okay, so on this one, what I can say is that we are aware of course a delay has been already granted. Since then, we have engaged at the highest level with the Commission, with the involvement of board member firms, representatives, and had started discussions on the CSDR to explore the possibility of further postponement of some of the measures. And of course, we all know mandatory buy-in regime is a critical area on that. So far, there is no indication at this point that further delays are envisaged. But what I can say is that we are fully engaged with the European Commission on this issue at the time of this summary, and we are trying to explore ways of achieving further changes of the timeline. I see no further questions.
There are no further questions.
Can I ask participants to use this opportunity to ask any further questions if you have? Would be happy to answer. If not, I don't see any further questions popping up. Let's wait a few more seconds in case somebody's typing, which we cannot see. Okay, if there are no questions, we would like to thank you for dialing in, for attending this short summary. We will continue our activities according to the schedule I explained. As Julio explained, we are planning to issue a sort of follow-up report on the impact of COVID-19. I would also like to encourage all members to approach us in case of specific concerns in your area of activity with respect to coping with the crisis. We will try to fit these concerns, these requests into our work streams and engage with the respective authorities as quickly as possible. Of course, we can't promise that we will be able to get answers or solve all these concerns, but we will certainly try. And when we think that we have got another milestone to inform you, we will try to organize a similar session and reach out to you to provide you with full information on what we have been doing and what we have achieved. So thank you very much again for your attention, and look forward to our next engagement in the not too distant future.
Thank you very much.